What this measure is called Ebitda. It's pronounced Ebitda. Ebitda. Don't call it EBITDA. People think you're crazy if you're like, hey, Miss Susie, what is your EBITDA? She'll be like, whoa, I have no idea what you're talking about. Don't be that person. Call it EBITDA. Some people like to call it EBITDA. Some people like to call it Ebitda. But you know what? Let's cut through all that. We're going to call it Ebitda. All right? Ebitda. What EBITDA is earnings before interest, tax, depreciation, and other one-time items. So EBITDA is earnings before interest, tax, depreciation, and amortization. Basically, what we're doing is we're trying to find out the true profitability of the company by removing these items that might be unique to this particular company. So we're evaluating the company's performance without factoring in financing decisions like interest. So if you have a lot of debt at your company, but my company doesn't have a lot of debt, well then that interest expense will play a big factor in net income. So we want to go above those financing decisions and look at the true profitability. We're excluding one-time events. So if you had a huge lawsuit and you have to include that as part of your income, well, we don't want to include that, right? Because that's not your true profitability. Or if you have a kind of like this crazy other income stream coming into your company, we want to exclude that, right? Those are kind of one-time items. We want to go above the tax environment. Maybe you have some special tax treatment that lowers your tax rate. Well, we want to get above that. That's not your true profitability. And then we have other non-cash accounting items like depreciation, amortization, stock-based compensation, and things like that. We want to get above that as well. So we want to get to the true profitability of the company, and that is why we use EBITDA. Now, EBITDA is not a perfect measure, but it is a universal measuring stick that everyone uses to measure profitability. And so it allows different companies to be compared to each other. So if you have company A and I have company B, well, if we look at net income, that doesn't tell us the full story. We might have these crazy kind of one-off items that are really screwing up net income. But if we can get up to EBITDA, then we can really start comparing ourselves to each other. So generally, EBITDA is just a more accurate way to show the company's profitability. So let's go ahead and go through just a simple example. Let's say that at your company, you have net income of $500,000. But then you have taxes of $75,000, so we're going to add taxes back into EBITDA. And then let's say you had interest expense of $25,000. Well, we want to add that back into EBITDA as well. And then let's say you had depreciation of amortization of $50,000. Well, we need to add that back in because that's not really an expense, right? It's not really a cash item, so we want to add that back in. And then let's say you had this crazy random revenue of $15,000. I'll keep using the solar panel example. Let's say you had a solar panel on top of your roof and you make $15,000 a year from that solar panel. Or if you had some other one-time expense from like a merger or acquisition or something else like that, we want to add back in those items. So that would get us to EBITDA of $635,000. So EBITDA will almost always be larger than net income because we're adding back in these other items. So now we've talked a lot about EBITDA, so let's go ahead and look at a real-life example using Snapchat. What I'm going to do is go back into the financial statements that we were looking at earlier, and then we'll look at how Snapchat looks at EBITDA. Now, EBITDA, everyone uses EBITDA. If you're in accounting or finance, everyone's going to talk about EBITDA. So you need to become very familiar with this term. So what I'm going to do, stop the video, and we're going to go back into the other financial statements. So we're back to Snapchat's financials, and this is on page 24 of their financials. You'll see it's right below results of operations. Now, like I said, all companies pretty much report EBITDA. Anyone who's in finance or accounting will always want to look at EBITDA over net income. And so right here we see revenue of $149 million. We have loss from operations of $2.2 million. Now that's loss from operations. Now remember, on the financial statements, there are some things that are operating expenses, and then there are some things that are like one-time non-operating expenses like interest, tax, and things like that. So this is loss from operations. And then you have the net loss. So at the very end, after you take into consideration everything on the financial statements, they lost $2.2 billion. Now, from an outside observer, we're like, whoa, that's crazy. How can you lose $2.2 billion? I could do a lot of really cool things with $2.2 billion. And somehow they lost $2.2 billion in 3 months' time. Well, then, if you look at adjusted EBITDA, so this is their own self-reported EBITDA number. They said, no. Really, we only lost $188 million. When I say only, I say that kind of sarcastically, like we only lost $188 million, not the $2.2 billion that we reported. So it looks a lot less worse than it actually is. So let's go into that. Why did they only lose $188 million and not the $2.2 billion that we see in net income? So let's kind of dig through that. Now, usually on the income statement, I'm just going to go back up to the income statement on page 6 or 8. I can't remember which one it was. All right, there we go. This is on page 6. Their income statement. So right here we see the net loss of $2.2 billion. And here is the loss of $2.2 billion from loss of operations up here. But then they had these interest income, interest expense, they had taxes and things like that. So then it came out to be $2.2 billion, or $2.208 billion, I should say. So here's the loss from operations. So if we were to take this $2.213 billion, and then we were to add back depreciation and other non-cash items, we'd get to that $188 million. So the financial statements, if you look at just the net income, you will never see these one-time items. So you can't get to EBITDA by just looking at the income statement, which is why we have the statement of cash flows. Well, not the reason, but one of the reasons why we have the statement of cash flows. Now, like I said before, a lot of people kind of disregard the statement of cash flows. They're like, oh, and then there's this other financial statement. No. It's one of the most important ones. And one of the big reasons why it's so important is because we can calculate EBITDA using the statement of cash flows. So let's go through that. I'm going to go down to the statement of cash flows, and this is on page 8 of the financial statements. And right here we see adjustments to reconcile net loss to net cash used in operating activities. We'll go through all of this in just a minute, but I want to focus on just a couple items real quick. Right up front, we have depreciation and amortization right here. So they break out that it's $12,455,000. Okay, so we would add that back into net loss to get to our EBITDA number. But that doesn't tell us the whole thing. We are still missing like $2 billion, right? Well, if we look below, we see this item right here, stock-based compensation for $1.9 billion. Well, that is a non-cash item. Now, it's not a very common item. We don't see that very often, especially if you're working with like a non-public company. You aren't going to see stock-based compensation. But what that is if I'm a public company and I want to give my employees stock instead of compensation. So I say, oh, instead of giving you a bonus, I'm going to give you $5,000 worth of stock. But you might not be able to use that stock for 4 or 5 years or whatever. And so this stock-based compensation, it's not really cash, right? They're not giving you a cash bonus. They're saying, here is some stock in our company. So it's not a cash item. It's not really expense. But according to generally accepted accounting principles, or GAAP, that is an expense that you need to put on your income statement. But it's not really an expense. It's kind of like depreciation. We have to put it as an expense, but it's not really an expense. So what I'm going to do is actually go back to the PowerPoint now that we see these two big non-cash items right here, and we'll see how we can back into our EBITDA number. So let's go ahead and reconstruct their EBITDA number. So here's just a snapshot of what I was showing you earlier. And so net loss was $2.2 billion, but EBITDA was only $188 million. So let's break that down. We can start with loss from operations, since that already excludes taxes, interest, and other non-operating items. So instead of starting from down here and having to add back all of these items up here, instead we are going to start from right here and then just go up. Next, we looked at the statement of cash flows and we realized that there were some really big non-cash items. There was $12.4 million of depreciation and amortization and $1.9 billion of stock-based compensation. So we need to add these items back in. They were non-cash items. They weren't really expenses if you want to think about it that way. So what we're going to do is we take the net loss of $2.213 billion. We add back in depreciation and amortization. We then add back the $1.9 billion of stock-based compensation to get us to EBITDA of $209 million. Well, I guess negative $209 million. Now, there are other components that they use to get to EBITDA that, I don't want to go through all the little nitty gritty, but those are the big items. And we're close enough, right? We're off by $10-20 million. And when we're dealing with billions of dollars, if we're off by, $20 million, it's kind of like a rounding error. We don't really care about that.